Welcome to exercise 10.1, this week's walkthrough video. In this one here, I'm going to read the question. Kelly Jones and Tammy Crawford borrowed $9,600 on a 7-month 10% note from Gem State Bank to open their business, JC's Coffee House. The money was borrowed on June 1st, 2017, and the note matures on January 1st, 2018. Part A asks us to prepare the entry record to record the receipt of the funds for the loan. In this case, we're just going to go ahead and debit cash because that's what we got, and credit notes payable because that's what we're going to have to give eventually here back. And that would be about it for the journalization. Of course, anytime you're journaling, remember to keep the date here. That's important. In Part B here, we see we have to prepare the entry to accrue the interest on June 30th. Now, since we took this loan on June 1st, that means we have 1 month's interest. We're going to need to calculate that, and to do so, just run with the interest calculation equation. So the face value of $9,600 times 10%, also known as 0.10, and then times just the one of 12 months, since that is an annual percentage rate, which gives us $80. $80 that we're going to do the journal entry for. Journal entry here we see the 30th of June. I don't know why I changed types there, but sorry about that. We debit then the interest expense and credit interest payable at this point. And then we're going to step to Part C. Part C here, assuming adjusting entries are made at the end of each month, determine the balance in the interest payable account at December 31st, 2017. Now this is essentially the full length of the loan, or the note, as it's due tomorrow, January 1st, 2018. So we need to figure out what 7 months would be. We could easily multiply what we learned from the first month in Part B times 7, or we can do it the right way and use the equation again here. $9,600, the face value of the note, times 0.10, the interest rate of the note, and then multiply that by 7/12, which is 7 of 12 months, which is the length of the note. And we come up with $560. That would be our balance in interest payable. And Part D. Part D says to prepare the entry required on January 1st, 2018 when the loan is paid back. So here we're going to need to have a couple things. We're going to need the date, January 1st, 2018. We're going to debit notes payable, therefore paying off the payable off our books. And we're going to debit interest payable, taking that money and removing that from the books as well by paying in cash, or crediting, if you will, $10,160. Notice that the $10,160 is the addition that comes along from adding both the note payable and interest payable. And this essentially wipes the interest and notes off of our book, as well as balances out that cash. The only difference in the balance of cash is, of course, the $560 in interest that we paid in order to borrow the money. If you have any questions on this, or any other questions this week, or any week for that matter, please feel free to reach out in the comments below. Myself will be monitoring these as much as possible, and I'm sure our fellow classmates would be happy to kick in as well. I hope you all have a great week and enjoy the 4th of July. Hopefully your class loads are light and you get a chance to do so.